Warren Buffett is 95 years old. His net worth is approximately $118 billion. Of that, more than 99%, roughly $117 billion, was made after his 52nd birthday. He started investing at 11 years old. He had 41 years of investing experience before most of his wealth existed. That is not luck. That is not genius alone. That is compound interest running across 8 decades of time. This is not a story about Warren Buffett the man. It is a story about what happens when above-average investment returns meet enough time. We are going to tell that story entirely through data. Warren Buffett was born in Omaha, Nebraska in 1930. His father, Howard, was a stockbroker. By age 8, Warren was reading his father's stock market books. By 10, he was visiting the New York Stock Exchange with his father on a family trip. At 11 years old, in 1941, he bought his first stock, 3 shares of Cities Service Preferred, a utility company, at $38 a share. Total investment, $114.75. Saved from delivering newspapers and selling chewing gum door to door. Cities Service dropped to $27 shortly after he bought it. He held. It recovered. He sold at $40, a small profit. Then the stock climbed to $200 without him. That early experience, selling too soon, became one of the defining lessons of his investing philosophy. By age 13, Buffett was filing his first tax return. He earned $923 that year, largely from his paper route. He deducted his bicycle and his wristwatch as business expenses. He was 13 years old. By 15, he had saved $2,000, roughly $27,000 in today's purchasing power, and used it to buy a 40-acre farm in Nebraska, leased to a tenant farmer. He was not yet old enough to drive. At 17, Buffett and a friend bought a used pinball machine for $25 and placed it in a barber shop. Within months, they had 6 machines across 3 barber shops. They sold the business for $1,200. He was not yet in college. He applied to Harvard Business School and was rejected. He enrolled at Columbia instead, where Benjamin Graham, the father of value investing, was teaching. Graham's philosophy: buy companies trading below their intrinsic value, hold until the market recognizes it. Ignore short-term noise. Find the margin of safety. Graham taught Buffett to think of the stock market as a moody business partner named Mr. Market. On some days, Mr. Market is euphoric and offers you an absurdly high price for your shares. On other days, he is depressed and offers you a bargain. Your job is simply to be rational when he is not. At 25, Buffett had grown his personal savings to approximately $174,000, roughly $1.9 million in 2026 purchasing power. He had done this through stockbroking, investing, and his early businesses, all while compounding every dollar he made. At 26, in 1956, he launched Buffett Associates Limited. 7 family members and friends contributed a combined $105,000. Buffett contributed just $100 of his own, but took 25% of all profits above a 6% annual threshold. Between 1957 and 1969, the Buffett partnership returned 29.5% annually, compounded. The Dow Jones Industrial Average returned 7.4% annually over the same period. He did not simply beat the market. He almost quadrupled it every single year for 13 years. If you had invested $10,000 in the Buffett partnership at its 1956 launch and stayed for the full 13 years, you would have had approximately $156,000 by 1969. The same $10,000 in the Dow Jones would have grown to about $21,000. In 1962, a failing textile company called Berkshire Hathaway was trading at $7.60 per share. Buffett began buying aggressively. By 1965, he had accumulated enough shares to take control of the company. He would later call the Berkshire acquisition his biggest mistake. The textile business itself was dying. He poured capital in trying to save it for years. But the cash it generated, while it lasted, funded something far more important. He used it to buy insurance companies. Insurance companies collect premiums today and pay claims in the future. The money held between those two events is called float. Buffett used that float to invest. He effectively had access to billions in low-cost capital that he could deploy into stocks, bonds, and entire companies. This was the structural engine behind everything. In 1969, Buffett dissolved the partnership. He felt the market was overvalued and could not find enough bargains to justify running investor money. His personal take from the dissolution, $25 million. He was 39. In today's purchasing power, approximately $212 million. In the 1970s, Buffett deployed his capital into what would become some of the most profitable investments in history. Washington Post Company in 1973 purchased at a steep discount during a media panic. See's Candies in 1972 for $25 million. Geico Insurance in 1976, nearly bankrupt, bought at a fraction of its worth. See's Candies deserves its own moment. Buffett paid $25 million for it in 1972. Over the following decades, it generated more than $2 billion in cumulative pre-tax earnings for Berkshire. That is a return of over 8,000%. The money did not stay in candy. It became capital for bigger investments. In 1979, Forbes magazine listed Buffett's net worth at $140 million. He was 49 years old. He had been investing for 38 years. On the wealth curve, this is still the flat section, before the exponential bend becomes visible. By 1982, at age 52, his net worth had reached approximately $376 million. He would not cross the $1 billion mark until 1986, at age 56. He had been investing for 41 years. And even after he crossed his first billion, he still held less than 1% of his eventual total wealth. Then the compounding curve goes vertical. By 1986, $1.4 billion. By 1990, $3.8 billion. By 1995, $12.3 billion. By 2000, $32 billion. The same mathematical process, returns compounding on top of returns, but now operating on a base large enough to produce billions per year. By 2006, he was briefly listed as the richest person in the world. By 2015, $67 billion. By 2023, $119 billion at peak, even as he was actively donating tens of billions of dollars per year to charity. He pledged to donate 99% of his wealth, primarily to the Bill and Melinda Gates Foundation. He has given away approximately $50 billion. Yet his net worth in 2026 remains near $118 billion. The compounding engine ran faster than the giving. Berkshire Hathaway has compounded book value per share at approximately 19.8% annually since 1965, a 60-year track record. At that rate, the rule of 72 tells us $1 doubles every 3.6 years. Applied to Berkshire's scale, the results are what we see. Here is the thought experiment the data invites. If Buffett had stopped investing at 65, the age most Americans retire, his net worth would have been approximately $9.3 billion. Still one of the wealthiest people in history. But 93% of his actual wealth was built after that age. Buffett is not a template. His returns are extraordinary. But the structure of his wealth creation is universal. Start early. Compound consistently. Do not stop. A janitor in Vermont named Ronald Red applied the same principle on a salary of $12 an hour and died with $8 million. The math does not care about your income. It cares about time. The lesson is not to become Buffett. The lesson is to understand what he understood at 11 years old. Time is the most powerful financial force in existence. The best time to start was 40 years ago. The second best time is today. If this story changed how you think about time and money, subscribe to WealthInFrames for more data-driven financial breakdowns. This is a historical analysis, not financial advice. Always do your own research before making any financial decisions.